What's up, guys? Logan here again with another video. Today I'm joined here with Halcyon Trader from the Discord. He's one of the newest trading members to our group, and he has these awesome calendar spreads. Now, as you guys know, I don't trade calendar spreads, but I'm going to begin trading them, so I'm super excited to have you on, man. How have you been doing?
Thanks. Doing well. This has been a fun start to 2021, and also interesting to get involved with the group and kind of unpack some different types of strategies and tools to use in your trading venture, especially with options.
Yeah, definitely. And I'm excited to see how you trade SPX because I don't personally trade SPX, and I know you have
Sure.
SPY for the smaller accounts as well. So I'm just really excited to see how this is going. But could you tell us a little bit about your background and just your experience with trading over the last, I'd say you've been doing this for how long again?
Many moons
Yeah.
at that point. Yeah. So my quick background, you and I talked about this a little bit offline, but we'll give
Yep.
everybody else a little sneak peek behind the scenes here. So I got involved with trading back in the kind of early-ish 2000s, around 2004, 2005.
Hmm.
I wasn't doing any options at that time. I was really just literally my kind of first baptism with what is a stock, ETFs, mutual funds, etc. The place that everybody starts when
Oh,
they
yeah.
when they start learning how to trade. At that time, it was a little different on the connection in terms of how much information was readily available or not. Obviously, the tools today are infinitely superior in terms of how much information you have at your fingertips.
Hmm.
But anyway, back then I started got involved with that. Started trading money around 2008. So
Hmm.
actually August of 2007 is when I first started my own dipping into the markets, so to speak. And that literally was the month of the peak of the start of the bear market that happened in 2008. So
Man.
that was a baptism by fire of holy crap, you lose money pretty fast when the market drops 60% in, about a year's time. So
Ridiculous.
that then fast forwarded me into this kind of long process of figuring out how to manage risk and understanding my risk
Hmm.
with trading, and that eventually led me to going through a number of, as many traders do, is learning as much as you can, doing a lot of YouTube, paying for some services here and there. But eventually, yeah, I had a mentor who, for me and the type of trading I like to do, really kind of unpacked, I would say, from a psychological perspective and from a risk perspective, the type of risk that I like to take, and which is I want to have a trade that I can manage and a trade that gives me the ability to have a lot less stress involved with it.
Mm.
And more importantly, I have preset when I get into the trade. I have preset action points that need to be done if the price action happens,
Mm.
and that was instrumental in really changing my approach to it. Once I understood what options are doing, how they work, the mechanics and components of what makes an option go up and down. That was instrumental in really helping kind of evolve into this current trading environment that I'm doing, which is a lot of calendar spreads. So
Perfect.
most people are probably not familiar with what those are, or they may see them as an order type, but have likely never put them on.
Hmm.
So I think our goal for this session is to just unpack at a top level what a calendar spread is trying to do. And then maybe we'll hit off some of those objectives of when, right? That's a big question, is when do you put them on? Because in trading, there's not a one size fits all for every environment type of strategy. I just don't believe that exists. So
Hmm.
our job as trading is to be consistent, and then to have tools that work in certain environments. And in my opinion, the calendar spread in this particular, on the SPX and SPY, the double calendar spread is really versatile with giving us room to work when we're in a higher volatility environment. And I, from my own trading style, I view that as roughly anywhere when we're about 20s, 21, 22 and up on the VIX
Hmm.
is when I like to put these calendar spreads on. And then we'll kind of unpack why and what I'm looking for and expectations and those kinds of things, as we put one on here and kind of dissect a little bit what's going on. So
Definitely. Yeah, that's fantastic. And I would say there's a lot of traders who started this past year who haven't even experienced the VIX under 20 at all. So it's really interesting.
yeah. right? I mean, the VIX where it is right now, that's unusual. I mean, it was what, 2012 to maybe 2000, I don't know, 18 or so, that
It's
it
like,
was around 12
yeah,
the
12,
whole
maybe
time.
15 if anything got crazy. It's crazy.
And that's like, yeah, I mean, that's a great time to do lots of credit spreads. You
Hmm.
know, I mean, when you have a very stable VIX, you don't have to worry about those wild movements of your underlyings. And so, SPX in particular, and thus it makes it a lot easier to predict and do some of those delta, 20 or delta 30 credit spreads that, are going to hit 90% of the time.
Yep.
And even if they don't, the market moves slow enough when you're at that lower volatility where you have time to adjust and tweak. Not so much the case when you're sitting at 20, high 20s VIX or even in the 30s. That's a whole different ball game, and you want to be careful with doing those credit spreads at that time.
Yeah, I agree.
So how about we just I have a credit spread that's sitting on the screen right now as you're looking at. This is the TOS system. I am running this one through the paper money side because for whatever reason with TOS lately, the paper money moves about 5 times faster than the live account. And so it's so much easier to click in and out of things and not have a bunch of lag going on. So I'm viewing it through here, but this is a trade I'm fishing it right now, trying to get it on. So this, you can see a kind of a real-time one that's going on. We are looking at the SPX in this one. So some questions: why would you use SPX versus SPY? And it really is a size issue. That's it. I mean, the SPX is going to give us more bang for our buck, so to speak. It's about 10 times the size of an SPY contract. And in calendar spread trading, we do want to take advantage of some of that size. But the reality is, if you're new at trading or if you have a sub $25,000 account, you can do it. It's a lot more challenging in terms of you're using a lot of your capital each trade. You don't give yourself a whole lot of room if you need to defend the trade because you've used all your capital up. So that's why I used to SPY if you have a smaller account size, and you use the SPX and you get a little bit more, a bigger account to work with. I would say if you're trying to give an idea from an actual account size for SPX, I would say probably I wouldn't do them with anything under a $10,000 account. I mean, ideally, you're more about 25 on that. But this is an SPX one right now, and so let's first maybe just unpack what is a calendar doing, and we will get into the kind of structure and shape and how we use ThinkorSwim to analyze and create all of our action points whenever we put one of these on. So fantastic. I'm going to start with the end, which is what this one is that you're seeing on the screen now. This is currently a double calendar. And just a quick little gist to know it's a double calendar is that your legs, your short and long legs, are the same price. If we're different prices, so let's say this call was 38.80 and the one down the bottom here was say 38.50, that actually then is a diagonal. They're like brothers to each other. They work and operate very similar. There's some environments where one's better than another, but we can get into that at a different video at a different time.
Definitely.
So here's the kind of end, what this looks like, and what we're looking at when we structure one of these trades. The first thing to know is that this type of calendar spread is designed around collecting theta. Okay, so again, understanding the Greeks and the way they work, theta really is just translated to time, right? And this is a positive theta trade, so we are looking at using time to our advantage, right? So in this particular structured trade, which actually is a little bit longer date to expiration than I normally use, again, we can unpack that differently on the actual trades, but for this current one that I'm looking at, it's a little bit longer out. Anyway, what it's currently paying today is 167.84. So if all things hold true and we live in a vacuum on the markets and the volatility stays exactly the same, then this will basically deposit into our account about $160 to $170 every day that environment stays exactly the same. Okay. The other way that you look at this trade is that we call this like the tent, and we've created this shape here with this blue line, the blue line being our profit or our loss at expiration. Okay, so profit or loss at expiration would be whatever these numbers are showing. So this one is about, if you got to this top peak, which is your put short leg, that you're going to be close to $20,000 gain on that. The call leg's a little bit smaller and it's maybe like 17 or so.
Wow.
Right? Now that is if all things stay equal, right? And we know they don't always stay equal. And we'll have to actually do a video where we show a really bad vol crush what it looks like, what it does to a trade like this. Like the one we've experienced over the last 4 days, where we dropped about 35 to almost 40% on the VIX, which of course is our volatility measurement, and you can see what it will do to a trade like this. So I guess that's also to add another point to this is in a falling VIX environment, these are going to struggle a little more. They do much better sideways to moving up VIX environments. Again, if we knew the perfect crystal ball and you could know exactly what the VIX is going to do, you sell credit spreads like crazy when the VIX is falling and it gets low. And if you know it's going to go up, then you make a lot of the calendars, or diagonal spreads.
And you're just tag team in the market right there.
And you just go back and forth. Yep, you just go back and forth doing that, and you let the VIX be the guide for which strategy you should put on. Right. So anyway, so that's what this blue line is showing. This purple line, right here, this is what we call our T+1 line. Reality, what it means is it's basically what Theta is doing. And it also represents a few different areas with skew and a couple of things, but we're not going to unpack that, what skew is and that at this point in time. If you're really curious, just Google search it. But we can do that at a different video, because that we'll be here for an hour talking about all those little. But ultimately, what we want to see is that the purple line stays above the 0 line, okay, which is this middle of the, here's 0 right there. All right, so we want it to keep above that, and that just means that Theta is being deposited, into our account. When it gets underneath it, is when we're not actually, we're basically the volatility is overtaking what our Theta is producing for us. Okay. Over time, if you're used to doing these and watching how these move and what their behavior is like in a trade, is that, again, a pretty stable VIX environment or moving up VIX environment, you'll see this purple line continuously moving this direction. Okay. And when it does that, it keeps pumping up the profit in the trade. Vice versa, if volatility falls really hard like we've experienced the last couple of days here, then it does the opposite and it deflates the profit potential in the trade, and this all gets stuck down here. So it's just, again, when you're looking at know your enemy or know the trade itself, those are things to be aware of. Is that falling VIX, just be aware you're going to get your profit sucked out of the thing, and if it's going up or sideways, then you're going to be totally fine in this. The other key thing is, of course, is how do you manage or adjust or need to, if you need to flex inside of a trade, how do you do that with these things? And that's, for me, why I like these so much, that you have the ability to manage and adjust on the fly without having a whole lot of thought process to go through with what you're doing with it. So in this case, our losing money points are down here, right? So we cross over 0 and cross over 0 on the top end. And so for this particular one, I have all the way up to about 39.25 and about 37.50, 7.58, something like that, give or take, a point or two. So that right there at the beginning of the trade, when I'm putting it on, I know as long as I'm underneath this tent, right, that I'm going to be in some way, shape, or form in a space where I'm in the money when I get closer to expiration, right? If I blow out the end one way or another, well, then I have to do something. So for me, the trigger is, when we get about somewhere around halfway down the slopes, that's where we're looking at adding on a defensive measure. Okay. And so you already have predetermined when you get into this thing is that, let's just make sure, somewhere around here is where you need to make some defense on it. These are designed to be able to do that. They're not designed to just sit it, do nothing, and just pray that it stays between the strikes. I mean, you can certainly do that. And there are some shorter versioned calendars that legitimately you can put them on if the market opens at the same place on a Monday and pull in $1,000 to $2,000 on that trade. That's legit. That does happen. I wouldn't do it in a high VIX environment, but it is a real thing. That is a real strategy to look at when you get in a lower VIX environment. Because we have a higher VIX environment, I'm doing 2 of them at a time. And that's why we call it a double calendar. So I want to get a little more spread. That's the only reason I'm doing it this way. If I didn't think we'd have the ability for the market to move up and down a lot, we've moved 160 points in 4 days on the SPX right now. That's a pretty wide space for it to move around. It's actually more than what the market makers were expecting this week. So it's just, you got to be aware of how these things can move, and I want protection just in case they go either direction. So as we look at the mechanics of how this thing is set up, I want to take the whole trade apart, and we'll build it one piece at a time, and then you can see how they all how relationships work together to then create the potential profit margins that you can get on these things. Okay. Does that sound good?
Yeah, sounds great.
All right, let's do it. So I'm going to take this off. So we're going to take the double diagonal off. And now we're down to nothing showing here, right? 0, 0, 0.
Yep.
And let's take each leg individually and put them together. So let's start with the call, right? So here's a call. Right? This is the 3880 call. And essentially, if the market keeps moving up and up and up and up, you can see that you have an infinite profit margin that can just keep going and going to the moon.
Yep.
That never really happens unless it's GameStop for a couple of days. But aside from that, most people aren't going to ever experience that, right?
Yeah.
So then you're selling the March 1st, or buying the March 1st 3880 call. This is what this looks like by itself,
Yep.
right? If you did this with any other position, you'd see the exact same style chart. It doesn't matter. Just swap the name, the symbol, and it looks the exact same way. Now let's sell a 26, so a couple days earlier, short leg here. And now we've created this shape when you combine them together. So if you notice, what you're doing here is that we want to collect the difference between the long and the short.
Gotcha.
That's all you're doing here, right? So when we say it's a theta positive trade, because let's take that back off. What's my theta now? I'm losing literally $1,000 a day in this SPX long call. So it's literally the cost for me to be in here for the right, or the option to execute this, is $1,175.
Wow.
Okay, so when you think about long calls, anything, you're paying for the time to be in it in case it goes up. However, in this step, when we add the short side of it into it, now we flip the equation around, and it's paying us $73 a day to sit into it, which is you're looking at from a weekly income type of perspective.
That's ridiculous.
That's not a bad deal, right? Okay. So again, and all you're really trying to do is just collect the difference between the price of both of these over that period of time while you get to expiration on the short leg. That's all. And so this is the window by which that is still in profit. So you notice we have the double on, we have a bit wider of a margin to work with. Okay, so it's 38, 32, 39, 30-ish on this call side.
Yep.
Okay. So now we want to make a double version, because again, in a VIX environment that's higher like it is now, which is it's currently whatever it is, 21, 22, the market can have the ability to move in a bigger point spread than you would normally otherwise see. And so thus we need to account for that. And therefore we add on the next leg, right? So now I'm going to add a put on here, the same expiration at the call. Look how it completely changes this trade, right? Now we go back to a negative 1300 theta. So I'm paying $1,300. This would be a wonky strategy to do. I don't know what you'd be hoping out of this, but but then we add on to the short leg of that, which again, all you're trying to do is get the difference between that long and short leg by expiration. And now we've made this shape. So we've spread it out from 37.60 all the way to 39.20. It's a pretty wide margin we're working with, and that's roughly within the expected move from now until that time.
Yeah.
Right. So we're just working with the information that we've been given, and that's again the way that we should be trading anything. Is you just base it off the information you have right now in the setups you're looking for. And so once this is put on, you can now see when it's all put together, we're looking at about $173 that we're getting paid to be in the trade. Plain and simple. Okay.
Every day.
Every single day. So assuming that VIX doesn't drop on you, you will get paid that every single day while you're sitting in this trade. Now, from an expectation perspective, what that usually looks like is, for whatever reason, it typically will come into the trade sometime around the middle afternoon. So from an Eastern Standard, sometime around 2 o'clock or so is when I usually see that bump into the actual profit of the trade, especially if VIX doesn't move around on you. It's kind of staying the same. And one of the other things with this analyze tab is it lets you see, let's just say that you keep the VIX stays the same. It stays roughly around that 21, 22-ish range from now until the end of this trade, and really price only kind of, we'll just say, oscillates back and forth from here to over here, right? That's all it's doing. It's not really moving too far up and too far down. This is what you would look like. So notice theta, right? It's at 166 right now. And here's the profit and loss at the open of this trade. As we keep giving it more and more time, a day at a time, you'll see how it keeps depositing into the account for you, right? So I'll move it a day forward and just watch what the P&L will do.
Okay.
Again, assuming that all things stay the same, which sometimes they do and sometimes they don't.
Right.
Let's go forward a day. So let's add one more day, 2.5, right? Now all of a sudden our profit and loss is putting some pressure on the volatility, moving up better and better and better. Let's go another day. Now we're at 2.6, right? So we're at the weekend here. So this is also the weekend trade.
Yep.
You're not doing anything, and Theta is still building over the weekend because, right? You're paying, you basically are getting paid for the time in the trade. So then let's go another day, right? Now we're at 2.7. Now we're at 3.87 in profit. Again, if nothing changes, and you can just see as you keep going and going and going, as you get further along in this trade, that starts accumulating and accumulating and accumulating. And what I say is like you're basically being paid rent for hanging out in this trade. You'll also know that, like, as you can watch your purple line here, is since volatility isn't changing, it's just building and building and building and building on this. So
that's fantastic.
And that's essentially if you break it in a nutshell, that's what a double calendar is trying to do. Single calendar is doing the same thing. It's just in this environment, I want it more spread on it. That's all. I just want more width in the trade, so I have more room to wiggle around on this if I need to. Mm-hmm. So then there you go. I mean, that's kind of the basic gist of this. Obviously, there's a whole segment due on how you defend these and what that looks like, but I think maybe we'll save that for a separate video than this one, and somebody can come back and take a look at that.
And there's a couple questions that I had that I just want to run through real quick, and we can
fire away. Let's do it.
The risk management ones. The other thing that I was going to say is, let's say you are trading SPY instead of SPX because you have a smaller account and you want to take advantage of the calendar spreads. What would be a good account size to start out with SPY?
Well, again, with SPY, because it's roughly 10 times smaller than what SPX is doing, you can really do any size account with SPY. You can, and there are, I rarely ever use it just because I want more the SPX side of it. But honestly, you can use it with any sized account because if you just do like this one right here, you see it's equal, right? Yep. Every leg is equal on this. Yep. Move off my annotation here, but they're all equals 10, 10, 10, 10. So you can size this up or size this down based on your own account size. So it's not that every single one of them has to be 10s or 5s or whatever. I mean, you can drop those down to 1 if you want to. It's just obviously you're going to just cut the potential profit by whatever you're dropping this down. So if you go to 5, you're cutting the potential profit by 50% from what I'm showing in this particular example. But like I said, it's the equal structure, still the same thing on this. But I would say from a SPY perspective, I know you can do them as small as $1,000 account. You can do these in there. You're not going to light the world on fire with making $10 to $20 at a time on it. But the reality is, if we look at what's our job as traders, right? Our job, first and foremost, in my opinion, is to learn how to be consistent. Yep. And once you get consistent, that brings confidence in. And once you get confident in your trading, you typically kind of unlock the next level for what you're trying to get to. So consistency and confidence is a huge, huge component of long-term trading. I mean, that's just from what I've seen and what I've experienced personally, that's a key ingredient, is to find at least some element of your strategy that's very consistent for you. And that, for whatever reason, what I've seen from a lot of other traders is that unlocks their ability to make more profits in other more aggressive style strategies. Yep. Whole truth, like this, what we're showing here, this is purely an income style type strategy. And yes, you have the ability to make those numbers of 20,000 type returns if you get to those short legs at expiration and you hit it right on the money. That's possible to happen. Does it happen often? Not usually. Mm-hmm. I would say maybe 1 out of 6 or 7 will get pretty close to that. Yeah. But you got to have a couple of ingredients perfectly lined up for you. You got to have a perfect VIX environment, and you got to land perfectly at expiration on that strike price. Yep. If that happens, then sweet, and that's great. And you're like you are high-fiving and running around, as that adrenaline high goes with trading. But I wouldn't plan it. The goal here is can you get 15, 20, 25% out of what you put into the debit for the trade. Yep. And move on to the next one and create a consistent weekly income over and over and over and over again. That's the goal of this style trade. And then for my own personal risk appetite with this kind of thing, which, like I said, everybody should understand what their own personal risk appetite is. Mm-hmm. I don't want this to be wild swinging all over the map. Like I just do not care to have my income trades doing that to me. I know what my expectations are, and thus I'm going to create something that I don't really have to think about. Like I don't want to have to wake up in the middle of the night wondering what are the futures doing and is this going to destroy my trade in the morning.
Yeah.
I don't want to think about that with the income side. With aggressive stuff, that's a little different animal, and you approach them a little differently. But not with these income style trades. They should be really set it, forget it for the most part, and you have some predefined defending points if you need to.
Yep, 100%. And you know how rare it is for the market to just like go completely berserk. Like if you step away for like 30 minutes, maybe in a high VIX environment, but to where you would be really hurting on one of these calendars.
Oh yeah. I mean, in this thing on the calendar, right? We would need the market to all of a sudden middle of the day here. I mean, it's currently at 38.54. We need it also in the middle of the day to jump 70 points for me to even think about doing anything on this, or fall, almost 100 points for me to even worry about that. And the beauty is, as this is moving around underneath here, it's not like you don't have the opportunity to make changes. And the reality is also when you're in a calendar like this and the market falls, what happens, right? Our VIX spikes up.
Yep.
And what happens when the VIX spikes up is it makes the underlying options more expensive. And keeping in mind, if we're trying to collect the difference between these two legs, that is favorable for us. We actually like that. I had a different one that was on 2 weeks ago that in a falling VIX that we had last week was Wednesday and Friday, I think, in a market dropping 2%. Yeah. The trade actually made money during that time. I didn't lose anything, and nor did I even worry about it because I had such a wide spread to work with. So, like from a weekly income perspective, you really can't ask for more. Is don't have to worry about the trade, and it can move big directions either way, and you're pretty much going to be okay for the most part.
Fantastic.
You have to tinker every once in a while, but
And with SPX, let's say you do have a $10,000 account. How much should you, I guess, roughly like a ballpark estimate, expect to make with like this style of spread with about a $10,000 account?
Yeah, that's a great question. So this kind of calendar, the reality is like if you're paying attention and you understand your risk on this, in a VIX environment where you're 20 plus ish, you should be able to double your account by just doing weekly incomes on with these kind of things. You probably should be able to do more than double. I mean, last year, these types of just doing these every other week essentially. The income style account was up about 150%.
Wow.
And that was almost exclusively doing calendars. I think I had maybe a couple other like single calendar and say like a Google or maybe I had a Tesla or two trade in there, but it was hardly anything outside of doing calendar spreads. And that was a relatively painless. Yeah, I mean, I had maybe 3 to 4 trades that I would say happened around the July, August timeframe, where the market just went literally straight up during that time, where I kept blowing out the top end of the trade and had to keep managing it, but I wasn't taking losses on it. I was just constantly having to tinker with it.
Yeah.
Just move a leg forward on it and create the same width that I had before. That was basically all that was going on with it. So
that's fantastic.
Yeah, I mean that's that again. But keep in mind, if somebody's listening to this video 2 years from now and the VIX is now back to 10 or 15 or something, that expectation is ridiculous, and I wouldn't expect that unless you were doing a modified version of this, which is the weekend version.
Yeah.
And we'll put that as a teaser for another time that we'll talk about how that works and how you can pull some serious money out doing that.
Dude, that's fantastic. 150% return. I mean, that's ridiculously good compared to, I think, SPY. DIA specifically, that index fund's up 6% in the past year. DIA as of right now. So like you outperformed DIA by, what is that?
Oh, we like crushed that. I mean, even in the month of January here, I think just the calendar alone, we closed the entire account was up, 12% for the month of January.
Yeah.
And that's the entire account moving up just on calendar spreads. I think there was only, 4 or 5 that I took for the whole month on this.
Wow.
And roughly it's about 10 to 12% is what the return is.
And that's already a year and most indexes.
That's yeah. And then if you're looking at like an ETF or a mutual fund type of setup, I mean that's what you want for the year.
Wow.
Now again, like this is more involved than just set it and forget and don't think about it. So that's something to factor too. It's not. I mean, again, they're in the right environments. There's the right strategy, the right tool for the right environment will make you a lot of money. It's just you need to understand what environment you're in and appropriately then adjust your strategy to accommodate what that is. Right? Create the consistency that you're trying to do. That's my opinion on that, and that's how I approach this from this weekly income perspective.
Oh, that's fantastic. I mean, that's the way to do it, and that's the cool thing with the weekly income, right? If let's say you do buy a stock and you hold it for 2 years, 3 years,
sure,
you don't get to see that money until you realize your gains, which is when you sell that, unless it's like a dividend stock. But let's say it's just a pure like growth stock like Tesla or something. You have to wait until you sell that to realize your gains. But with this strategy, I mean, let's say you do close your positions at your 20-25% profit goal. Then you have that money now freed up that you can move and put somewhere else, like that opportunity. You don't have to worry about the opportunity cost as much because now you have that money to where like,
exactly.
Anything comes up in your life, like an opportunity to maybe start a business or whatever, right?
Sure.
You have that money freed up, and it's not like, oh man, I gotta hold these, shares so I can make that, so I can hit that goal or whatever. It's really, really interesting, and that's what I like so much about all the spread methods, right? Is it's a weekly, like at the end of the week, where your account stands if you just traded those specifically.
Yeah, absolutely. That's a really good point. They can't be. I mean, it really can't be said enough. If anybody who's ever traded options for any period of time, you have watched the wild swings that can happen in the portfolio, and those who maybe who dipped in first, maybe just for this, 2020 was the first time they ever got involved in it. I would say that was a typical year for sure, but it was a great year to be doing credit spreads because we had once you got past March, it was a falling VIX environment for pretty much a falling VIX for sideways VIX for almost an entire rest of the year. So credit spreads were just crushing it during that time as well. I mean, it was at least hitting your singles and doubles with them consistently, 90%, maybe 95%, I would guess, is you would hit post March on credit spread wins. I'm going to guess it was somewhere in that range. So, and similar with calendars, like I think the calendars statistically last year, even through the February, March craziness, you might have hit like 85, maybe 90% on them.
That's incredible.
And even the losses that did show up are very small and very manageable. Again, you're watching what's going on the whole time. It's not like you're, you close your eyes and look back 2 weeks later and see what's going on. I mean, you're adjusting because you know what your adjustment points are if you need to do it.
100%.
So, yeah.
Yeah, that's really awesome, and we'll get into risk management in the next video that we do together. But those were like my main questions so far for this video. But what has me really excited is that theta decay. Every day, that the fact that you could just make whatever it is based on your position.
Yeah.
I mean, you could be watching the Super Bowl and not even have to worry about betting on the Super Bowl because you got your calendar spread chunking your theta, and you're still making money on the weekend. Like, it's really interesting.
Oh, for sure. Like, I mean, today's what, Thursday? Yeah, we're at Thursday. So let's just say out of curiosity, let's just look at what the weekend trade would look like. Again, I wouldn't do this, and if you're seeing this, don't do this. But let's just take a peek at this. Not worth the time. Not enough money out of this one. Gotcha. However, there are structures and ways that you can create this where it's about $1,000 to hold over the weekend.
Wow.
Friday to Monday, and then if it if it expires the way you hope it's going to, then that is a heck of a weekend for doing nothing. Again, that's something, a strategy you would normally consider when you get a little bit lower on the VIX, and it's something that maybe we'll start unpacking as we get past the learning curve of using the double calendars. We'll start unpacking a little bit on when the right environment's there for it. But
definitely. Yeah,
I mean, it's again not a lot of work to make $1,000 over a weekend.
No.
So this trade didn't show it very well, but it's a real thing that happens occasionally.
And then you prefer the double spreads over the single when the VIX is high, correct?
Yes, correct. Only because of the fact that I want to account for the width that it can move, because again, higher the VIX, the more likely we're going to see these big moves one way or another.
Mm-hmm.
Again, there are some legitimate strategies where you can set these up. For example, like let's take this calendar, let's make them a little bit longer. So let's just put them in the current date that's existing now. What is it, March 1st? And just structure this just a little tiny different. Just move the strike around just a little bit,
Mm-hmm.
and you can see how different this type of strategy is going to play. So let me move this up to say 3,900, right? And we'll uncheck this because that's not what the actual price is. So let's just say we have a bullish lean on the market, and we feel really good about where we think the market's going to be going over the next, in this case, is the next couple of weeks, 3 weeks or so.
Mm-hmm.
You're giving all this runway for the market to move up to 3,900, and it's costing you nothing to sit and wait for that to happen,
Mm-hmm.
right? Because you're not paying to be in this trade. You're not paying you're not paying whatever that call option would be. Yeah, you're capping what your profits are going to be, but you're also completely managing your risk,
Yeah.
right? And again, when it comes down to consistency in trading, it's that I would say more important than looking at what your top end profit potential is capping and managing your risk and getting consistent. That I would argue is going to make you long term a lot more money than only focusing on how much can you possibly make in each trade. So again, totally legitimate strategy here is because you notice your purple line is positive, you're over the zero,
Mm-hmm.
and thus you're not paying to sit and wait to see does the S&P keep moving up, right? I mean,
Yeah,
you're
can
just
sit
not,
in
and
it.
that's the way this strategy is designed. Vice versa, we could say, hey, look, I'm feeling a little bearish on this market. Let's go to 3,800, flip this around, and now I'm going to get paid if this thing starts drifting back.
Mm-hmm.
So talk about looking at hedging your portfolio. Calendars are a great way to hedge, and guess what? They also make a lot more money when the VIX is going up. They will, you'll pile profits in when that happens,
Mm-hmm.
if that is how that takes place. So again, different, a little, just other ways to either play a bullish movement or a bearish movement. Again, the ones looking at with the double calendars are completely directional neutral. We don't really care what way the direction goes, but there are ways to manage and tilt and adjust this that is a specific way you think it's going. And you can do this with stock. It's not like it's just with the SPX. It works pretty well with a lot of the bigger stocks, so your Amazons and Facebooks and Googles, Netflix of the world. It works well inside of those, especially if you have a bullish or bearish lean on them one way or another.
Definitely. No, it's fantastic too. The large and I like this strategy a lot too because like you said, even though your potential profits capped, I mean playing SPX, playing SPY, I mean those are just those indexes. It's not like they're gonna
Yep.
run 50% in a day like a lot of the single stocks that a lot of people try to, like a lot of the
Sure.
like maybe
Sure.
Fubo or other stocks that are worth maybe $20 a share that end the day at like 30, because they have some
Right.
news come out. So that's what's really cool is you're not paying that theta and you have a realistic shot at profit based on the expected move for the week.
Correct. And that's, again, you work with what the numbers they're giving you, you work with probability,
Yep.
right? And that's, as option traders, it's all based around the probabilities of in the money or out of the money. And we take what it gives us. We don't waste our time trying to be right with the market. We waste our time trying to make money in the market. And
Right.
ultimately, that's, you just figure out the tools that work for you, that work around your risk appetite and your temperament for handling volatility. And you mix and match some strategies, and you find a formula that will thrive for you and make your portfolio grow inside of whatever the environment is doing. And like I said, right now as it stands in early 2021, double calendars are on the SPX SPY are working very, very well. I mean, they are extremely versatile, give you lots of room to manage and adjust if you need to, and are pretty high chance of making weekly income for you. And again, I mean, if it's an income perspective you're looking at, that's you can't really ask for more than that,
Right.
especially because you got a lot of room to work with.
Yeah, weekly income. And my very last question that I had is how long do you plan on holding a trade based on, like down there, I see that you have the March 1st and February 26th. And I know that this is all for the example.
Sure.
But How long do you plan on holding a trade? Now, I know you have that 20 to 25% profit goal before hopping out, but is
Yep.
there like a
Yep.
ballpark of a week and a half or 2 weeks or even a couple days to where
Sure.
you do see you hit that 20% goal and then you're done? Because I know that's probably my biggest question was seeing that you're buying and selling different expiration dates, right? Because
Yeah.
that's
Yeah.
the calendar edition. That was kind of what I was thinking. I was looking at them like, okay, so would I expect to hold this for 2 weeks, 3 weeks, the whole time? And I know you touched on not holding it all the way through, but
Yeah, that's a really good question
yeah,
because right, like, we're always trying to manage expectations.
yep, just the expectation portion, yeah.
Yeah, for sure. So let's just say we fast forward and we put ourselves in the middle of March at this point in time.
Mm-hmm.
And what typically is going on is that we usually will find, again, VIX pending. We will usually find one or two, setups each week that you're creating for roughly about 2 weeks away from that time frame. And once you get a little ways into this, what should happen is that you should have one that's essentially in a week of expiration every single week when you get a little further down this.
Mm-hmm.
So, from a goal perspective, right? So, if you're looking at your own trading plan, what I'm trying to get out of these are about 20% on whatever the debit is that I paid on those. So, I'm trying to get about 20% that statistically, if you back tested it, it's a pretty high win rate or at some point you touch that 20%
Mm-hmm.
return on the actual calendar spread in this current environment. On occasion, like I said, I say about 60% of the time that happens, and sometimes that's sometimes that can happen within 2 to 3 days after putting it on. You hit that 20% right away, and all right, on to the next one. Or I'll take it off, take the win, and then I'll reset it. I want, or if it's too far up on the graph in one way or shape or form, or too far down, I'll just reset it and then put it back on for to remain to that same time frame. Sometimes that happens, but I would say about 60 to 65% of the time, you're going to touch that 20% return at some point within the trade. I would say maybe 10, 15% of the time max, you're going to wait all the way till the end of the trade to get rid of this. But the only time you would do that is if the two things that we talked about before, but is if you were sitting right here,
Mm-hmm.
right? Or sitting right here. Otherwise, what usually happens is if the VIX falls on you during this time that you're getting close to expiration, you'll see all the profit gets dropped out of these things, right? Because the VIX is falling. So just something to expect is that the closer you get to expiration, the more odd movements we see happening with your profit, with your theta and the volatility relationship. They move all over the place really fast. So if you've ever experienced a long call that's at the date of expiration, you can see how fast they move up and down in profits. There is a bit of an experience that happens with calendars like that as well. So again, the best case scenario, the most perfect ideal way is that, say, this guy is where it is now,
Mm-hmm.
and we're a day before expiration and the market starts to sell off. That is where you hit home runs in these.
Mm-hmm.
Because what will happen, of course, is that you blast up the volatility and you move back into one of your short strikes. And that is the grand slam home run way of making a ton of money on these things. And that's where you go from, instead of trying to pull out 1,000 to 3,000 per trade, you can hit that on occasion $15,000, $20,000, $25,000 win
Per trade.
on them.
Oh,
I wouldn't bank on that being the case, but that's the perfect scenario and perfect storm for making that happen that way. Otherwise, like I said, typically I'm trying to look at around, I don't know, between 10 and 20 days to expiration is usually where I'm rough trying to put those on. Again, it's all vol depending on when you use one or the other. And then usually I'm trying to get that 20% out within the first. I do a 10-day one, it's usually within 5 days. If I do a 20-day one, it's usually within 7 to 10. I'm trying to get that out of there and move on to the next one, and just keep rinsing and repeating as long as that market and volatility is giving me the setups that I'm looking for.
Oh, that's fantastic.
I think we have fire hose down enough people at this point. We'll let them ask what other questions they want to ask, and maybe we'll make some separate videos that are zooming into some specific questions. I mean, some of the natural ones are always how do you defend that, but that's the whole separate
And
video that we
we'll
can
do
talk about
that.
defending and showing what that looks like when you need to do that.
It's going to be everything for us today, guys. I appreciate having Halcyon Trader on, as he's one of the recent premium member traders, and he just joined the Discord within the last couple of weeks. So I'm super excited to have him. He's also helped with a couple Zoom calls already. So he's just been a super helpful trader so far. And I look forward to having you on in a separate video. Hopefully we can get another one going next week if that works for you. But I really appreciate this, man.
You got it. No problem at all.
Cool, cool. All right. Don't forget to leave a like and sub on this video, and we will see you guys in the next one.